India's economy is one of the fastest growing in the world, with numerous opportunities across multiple sectors and market caps. Retail investors looking to tap into this growth need a well thought out strategy to ensure they benefit from the long-term growth potential. To help investors navigate these opportunities, Groww Mutual Fund has introduced the Groww Multicap Fund. This fund aims to potentially provide exposure to a diverse range of market caps, helping investors capture growth from various segments of India's economy. To give us more insights into how investors can make the most of this dynamic market, we are speaking with Mr. Schubert Mendes, a seasoned financial advisor from Goa with over 2 decades of experience. In this conversation, he shares his valuable advice on how to avoid common pitfalls in investing, including the importance of staying disciplined and focusing on long-term wealth creation. Please note this video is for educational purposes only and not a recommendation. Before considering any investment, be sure to read the scheme information document or SID carefully and consult your financial advisor to assess its suitability for your financial goals. Let's get started. We have with us Mr. Schubert Mendes to talk about everything that you need to understand before diving right into investing into India's growth story. Schubert, thank you so much for taking time out and talking to us today.
My pleasure.
Well, there are so many opportunities in the market right now across market caps, across the multiple sectors. How exactly do you think can mutual fund investors sort of navigate the host of options that are available out there?
Yes, Karunya. And we also thank you so much for having me. It's such a delight to be sharing my insights over the last 26 years that we've been giving investment advice. So you're absolutely right. There's a plethora today of so many opportunities. So the best thing to start with is by understanding your need first. You see, so once you have understood what is your need, what is your goal, then it is best to ensure that you have selected the option that suit your need. Okay, the popular saying, one man's food is another man's poison. So you have to understand that just as each person is unique, the investing approach or the investments that you choose have to be unique to your goal, to your need. Of course, keeping provision for events that happen like COVID. COVID, as you know, everyone's goals just changed, or for that matter, any event that may come. So, given the first thing to understand, at least in what I have seen over the last 26 years, investors who have achieved great investment success are those who have taken advice and first understood their goals, their needs, okay, and have stuck to two important principles of that. One has been wealth creation and second has been wealth management. Creating a portfolio, one, that is suited to their needs and opportunities, and second is wealth management, where they ensure that this portfolio is serving their lifetime purpose over the next 20, 30, possibly 40 years.
So given the evolving economy that we're all, a part of, how can investors manage their biases, whether it's focusing only on sectors which have been performing well of late, or other emerging trends that keep coming and going, right? So how to manage your biases in a situation like that?
Yes. So, yes, it is now every human being, I would say, let's put it this way, as humans, we are bound to go by our emotions. You see, so when the markets tend to fluctuate, or when suddenly there's a new sector which is upcoming so well, and it's just taking so many of, perhaps my people in my friend circle are talking about it, or social media is talking about it, then why should I not be a part of it? So this is where the first thing that you have to see is that I am investing today to take care of my spending power tomorrow. That is the first. Go by a simple basic rule. Why am I investing today? I have a choice of spending my entire money, but instead I'm choosing to invest it. So why am I investing? I'm investing it today that 3 years, 5 years, 10 years down the line, I have a great spending power. Now, for that, if my portfolio is well adjusted to inflation, or rather my unique inflation. Now, why I say my unique inflation is because, given our 4,300 investors that we have single mothers, we have people who are single, then people who are married, people with children. Now, being a father of 2 children, I can tell you education inflation is very high, as well as medical inflation. So my inflation would be higher than a person who would be single or a person who would be, say, retired. You see?
Yeah.
So the best way to handle your bias is to understand that if the current portfolio you have designed and keeping you above inflation, there is no need to deviate to the path, from the path. Because deviation comes at a very high risk, you see. And then suppose for some reason if it doesn't work the way, or there are fluctuations, then it can derail your progress towards your goal. So the best thing would be is this way. Now sectors, speaking of sectors. Now in my 26 years, sectors have their own risk. So please take sectors when you have understood it well. And the best way to overcome risk in sectors is to buy it at a discount. Strategic investing. So always go by a simple thing. Manage your biases by coming down to basics.
Thanks for sharing things or the approach to follow. But I also want to understand what are some of the common mistakes that investors tend to make when, especially, they try to time the market, and how does this typically tend to interfere with their strategy or their goals of gradually compounding their wealth. So how does that come in the way?
Yeah, I think the best answer to this would be Warren Buffett's interview. As you know, Warren Buffett was widely acclaimed as the most successful investor. And in an interview, he was asked he said that my strategy of investing is very simple. To which he was cross-questioned, then how come people are not rich? So, to which he said, because people do not want to grow rich slowly. So, if I may say so, the common mistake or the tendency that a lot of investors, especially investors who have newly come into the market, is that please remember that wealth creation is a journey. You have to give it time. So, the first common mistake is you have to believe in the power of compounding. Number two, please understand the market will have its own mood. Market will never go the way you want it to. So do not make the mistake of predicting, the market will be like this, and so my portfolio can be like this. No. The market in the short run is most unpredictable, but in the long run can be a fantastic wealth creator. And the market rewards the patient, consistent investor at all times. So at all points of time, it's always better to have a mentor, have an advisor who can handhold you, especially through market fluctuations. I've seen the subprime crisis, I've seen COVID, I've seen so many fluctuations in my 26 years. Remember, the market will have a cycle. It will not go one way up, it will not go one way down. It has a tendency to surprise you. But the best way to overcome this is by stay the flow. Keep compounding your returns. Go for diversified. My experience. Go for diversified equity if you're venturing into sectors. And of course, please remember there has to be a time where you have to move from wealth creation to wealth management.
No, I was just getting to that because disciplined allocation strategy or a steady, way to invest is something that you just reiterated, and all the market mavericks, all the wizards of the market have also often echoed similar ideas. But what role does it play, like that of a multi-cap fund, for example? That also entails a disciplined strategy, disciplined allocation strategy. So what role does that play in long-term wealth creation, and how can it be beneficial for investors who are looking at navigating different markets?
For an investor who's now, to navigate different market cycles, you have to remember is that how would you like to go about this? Now, the best way to go about this is by selecting a fundamentally sound mutual fund, preferably a diversified equity fund, which has a good years of experience or which has a good sound objective that suits your investment horizon and your investment goal. And then sticking to that strategy, unless it so demands that you would have to change it altogether. Okay. Now, I also believe that a good, strong portfolio is a creation of two important factors. One is the fund, of course, and second is the contribution of the investor. So keep boosting the fund at various. If you have selected a diversified equity fund, parallelly create a liquid fund or a debt fund. So that when opportunities come, for example, we are right now at a good opportunity where the Sensex from 85 is at 81. You see, so this is a good opportunity for those who have parallelly created liquid funds to switch into a diversified equity at the low. So you are not just investing, doing your SIP, but you're boosting your own portfolio by parallelly creating a liquid fund, which can either help you in investing or ensure that should there be an emergency, you are not disturbing the compounding of your equity fund.
Yeah. All right. Great. Great chatting with you, Schubert, and thanks for sharing your insights and thoughts on investing, and especially on a multi-cap fund strategy as well with us and our viewers. Thank you for joining us once again.
My pleasure. Thank you for having me.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.